Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Ice raw sugar in New York. The market since mid-January has run down along the underside of the purple highlighted upper time, currently at 1936. Of the early November 2023 to mid-January 2024 bearish shift pitchfork for a large part of its time. In late February for a few days, and then again in late March until early April, there had been a strong drive higher over the upper time, but the move failed, and the bearish shift pitchfork repaired itself. The first time up was halted at the overhead congestion between 2390 to 2408. The second time by the combination of the congestion in the 2235 area and the then declining short medium moving average, currently at 2063, and also the influence of the declining medium moving average, currently at 2161. Prices 6 weeks ago started pushing down through the familiar stratified congestion zones between 2140 to 2148, 21 even to 2107, 2069 to 2076, 2047 and 2003. Now this general zone between 2010 to 21 even also features as a congestion area back between January and February 2017. By Thursday 6 weeks ago, prices had pushed on back down within the purple highlighted bearish shift pitchfork, as well as down through the April 2021 to April 2024 uptrend, currently at 2028. All the way down until the bright red highlighted April 2020 to date uptrend, currently at 1939, and just short of the bright green August 2022 to date uptrend, currently at 1886. The market staged a small turnaround 5 weeks ago, but to be honest, the turnaround was, to put it mildly, modest, with the market being capped by the broken April 2021 to April 2024 uptrend and March 2023 low at 2004, and supported back then by the broken bright red uptrend and the since broken light green uptrend. In all this, I said 3 weeks ago, and I quote, "It looks like the bearish purple shift pitchfork might have started to reassert itself, but I give it a few more sessions to verify." Now, overshadowing all of this is the monthly key reversal down pattern I warned about 3 weeks ago, coming to fruition at the end of April. There are two final patterns that I would like to discuss once again, as I said 3 weeks ago, and I quote. The first is the late February to date bear channel, highlighted in dark blue on my daily chart, currently 1811 to 2104. It is still somewhat nascent, but it deals with the price action outside and above the purple highlighted bearish shift pitchfork rather well. We'll see how this idea develops, but as I say, right now it looks good. Then there's the action over the last 2 weeks, so that is now 5 weeks ago. Then there's the action over the last 2 weeks, and I'm wondering if this is becoming a bearish halfway hesitation or a bottoming action of some form. Right now I'd edge towards the bearish halfway hesitation, but it's still very early on this idea, end of quote. Well, the bear channel has developed and it's still there, driving prices lower, with the market trailing along the lower bear channel line, and now under both the bright red and bright green broken uptrends. Indeed, we have the lowest low last week since October 2022, and we are currently testing the 50% absolute Fibonacci line at 1809 for the action since the start of this century. It's absolute 21st century Fibonacci line. As for the action being a bearish halfway hesitation, well, apart from the 21st century absolute Fibonacci line at 1809 and the lower bear channel line, we have little in the way until the highs from 2017, down in the low 17 even zone. There is enough of a move lower for me to start looking at the bearish hesitation as having been formed, thus target X down in the 17 even zone would seem a reasonable effort. There is just one more feature I'd like to discuss, new feature, something I only really managed to see this week. It's to look at the dark blue lower bear channel and the purple upper tine, possibly forming together a descending wedge pattern. It's early days on this one now, but I would keep my eye on it as a possible new pattern brought forth from two older patterns. Ice Europe white sugar in London. The market from the middle to the end of January had been wading down through stratified levels of support and turning into resistance above, such that prices had dropped down below the interesting 625.30 to 602.70 congestion area, and also down below the October 2022 to April 2024 uptrend. That's currently at 614.60. There was some further congestion below between 590 to 592.80, but the changeover gap in mid-April ultimately took care of that, with prices opening the lowest since March 2023. This new gap had prices down below the recent stratified supports and into open territory that just had the February 2017 high nearby at 565 even, and then really nothing until the March 2017 high at 548.70. Well, the market realized what this looked like on a continuous daily chart such as mine and stabilized for a bit, though not filling in the gap from 613.40 down to 580.30. Now, there's always a tendency for markets to fill in gaps, including changeover gaps such as this, though I would not quote from my commentary from 2 weeks ago when I said, I would not suggest holding your breath for this one to happen, end of quote. This brings me to a point I raised 5 weeks ago, and I quote, over the last few weeks I've been voicing a question here that I have been posing to myself. It is this. Is the action since early December last year, is it developing into a double bottom or some sort of wedge or triangle pattern? Last week it was still too early to tell, but I'm more confident now, that the late December 2023 today action is perhaps a possible descending triangle. I've outlined this triangle on my daily chart in bright red. Now that currently is 595.30 to 649.20. This is a pattern to watch, just in case it morphs into something else, end of quote. 3 weeks ago I was unsure about this pattern purely because I do not like the changeover gap that caused the market to drop below and out of the pattern in the first place. It didn't mean that it wouldn't work, it's just that, well, I'd rather it move down during the course of normal trading rather than gapping lower like this. However, I also added the following 3 weeks ago, and I quote, now that we are here, it would seem appropriate to set out some potentials below for the possible and somewhat short-lived descending triangle pattern. Thus, a primary target X for such a pattern, it would be down in the 544.80 zone, whilst a harder secondary target X1 would be down in the 497.60 zone, which is off the bottom of my daily chart back then, end of quote. Last week, prices moved down and reached target X, leaving just a harder to reach target X1, down at 497.60. I further added 3 weeks ago, and I quote, I would only now add the small postscript that the action over the last 2 weeks or so has grown to become possibly either a bearish halfway hesitation or a bottoming action of some form. Here likewise, it's too early to tell which it may be, if any, though I have a natural disposition to look at it as a possible bearish halfway hesitation. But I could so easily be wrong, end of quote. Last week the market clearly became a bearish halfway hesitation, despite the changeover gap. This week I've laid out some potentials for this pattern, thus a target X2 down in the 510 even zone would be a conservative move, whilst a fuller move down to target X3 down in the 486.30 zone would be the more ambitious move. The only other feature that I would draw your attention to is once again the monthly key reversal down in April. Without the changeover gap, this would not have happened. So you can see there's a lot riding on this one gap. Sugar white premium spread. It must be over a year now that I've found many things still going on this daily chart all at the same time. Okay, so I've previously spoken some while ago now about two big picture items in here on this weekly chart. We have the recurring big old bullish Andrews pitchfork from 2019 to 2021, highlighted in dark blue on my weekly chart. It's a lower time, currently at 137.75, tested but not broken or really breached until last week. We also have down here many of the moving averages between 130.5 to 140.25. Above, we have the congestion between 162.75 to 164.75 that had until recently the rising neckline extension of the June 2021 to May 2022 reverse head and shoulders bottom, currently at 166 even, plus the 2012 high at 164.75. There's also further congestion above between 173.75 to 175 even, So after this, we have a pretty clear area topside over the congestion at 178.5, all the way up to the dark blue middle time, currently 211.75, the same bullish Andrews pitchfork. 5 weeks ago, the market made a huge combined weekly key reversal down and bearish engulfing pattern. I suspect this was in large part due to the London Sugar Month changeovers, but it nevertheless still effectively countered the previous week's bullish closing white Mariposa. Back then, I also considered topside targets for the big February 2022 to August 2023 diamond top pattern. However, 4 weeks ago, we'd had enough of that dreaming, and I decided would stick to the cold, hard, immediate reality and consider the dark blue lower time, along with the nearby moving averages, as the key element in this market. And no more than that for now. Thus, we come to last week's action, and it was a somewhat dramatic weekly key reversal down that not only closed below the medium moving average, currently at 140.25, and the short medium moving average, currently 135 even, but importantly closed below the dark blue lower time of the big old bullish Andrews pitchfork from 2019 to 2021. We actually closed right on the June 2020 low at 134.25. Prices did also manage to penetrate the 50% Fibonacci line of the August 2021 to September 2023 move at 131.25, but stopped just ahead of the flatlining long moving average, currently 130.5, and the 50% Fibonacci line of the July 2019 to September 2022 move at 128.75. This is the first time the market has been below the lower time since that break lower in early February 2023 that was swiftly turned around the following week. Thus, we would pay a special attention to what happens this week and whether prices can maintain the bearish incentive and perhaps finally break down properly through the 50% Fibonacci line at 128.75. However, I have a suspicion that prices might go the way of the February 2023 action and rebound back up. Early indications this week seem to justify this bullish reactionary move, but we'll have to see the whole week to verify it.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.